Welcome to another podcast of the Riffle series. The Riffle is a podcast series brought to you by 10 Leaves. Okay, today we are undertaking a deep dive into the core guidance manual of a major international financial regulator, the Abu Dhabi Global Markets Financial Services Regulatory Authority, the ADGM FSRA. Now, compliance material like their guidance and policies manual, the GPM, it can often be, pretty dense stuff. But we're going to extract the fascinating details that reveal exactly what it takes to be seen as trustworthy in ADGM and maybe highlight the surprising breadth of power the regulator actually holds.
That's right. And our mission here is really to synthesize the ADGM FSRA's commitment. What they're trying to do is foster a fair, efficient, and importantly, responsive regulatory environment. The GPM, it's essentially their policy roadmap. It explains how they apply their risk-based approach across, everything they do, authorization, supervision, and of course, enforcement. For you, the listener, the ultimate takeaway is understanding just how high that bar for integrity really is. It's not just for the firms, the legal entities applying for licenses. It's also very much about every single individual involved in running them.
So we're tracking the full journey today. How an applicant gets the green light, how the regulator keeps an eye on things afterwards, and what actually happens when rules get broken. Right, let's start at the very beginning then. The GPM itself. Our source material makes it quite clear that this is, it's guidance, it's a policy roadmap. It explains how the regulator might act, but they aren't strictly bound to follow it every single time, are they?
No, exactly. It provides transparency, which firms absolutely need, but it doesn't completely tie the regulator's hands if, a unique or unforeseen situation comes up. That discretion is important. And it's important because the whole system really, it rests on one single core legal principle, the fit and proper standard. The burden of proof, the onus is squarely on the applicant, whether that's the firm itself or an individual within it, to demonstrate they are willing and, crucially, able to meet all their legal obligations.
Okay, and structurally, what are they looking for? The GPM mentions requirements for the applicant, typically needing to be a body corporate or maybe a partnership. And they also have to set up a physical office, right? Maintain a real presence in ADGM.
Yes, both are key. The corporate structure requirement being a body corporate or partnership, that's about accountability. It defines liability clearly and ensures there's a specific legal entity the regulator can actually hold responsible. And establishing a genuine presence, that's not just about having a mailing address. It demonstrates real commitment to the jurisdiction, and practically speaking, it makes effective local oversight possible.
I found the flexibility around the regulated activities quite interesting. You can apply for combinations, maybe advising and arranging transactions, for example. But if you do combine them, the firm has to satisfy the criteria for both activities, obviously, but also, and this seems critical, have solid systems to manage any conflicts of interest that might arise.
Absolutely. Conflict mitigation is crucial, and so is public perception, actually, which leads to naming conventions. The regulator takes this very seriously. Firms need explicit consent to use potentially loaded words like bank, insurance, or fund in their official name.
To stop anyone being misled.
Precisely. It's all about making sure the public isn't confused about what the firm is actually licensed to do and what its legal status really is. Transparency again.
Okay, so that's the entity. Now let's shift to the individuals who actually run it. The approved persons, people like the CEO, the compliance officer, the MLRO. The GPM spends a lot of time on the criteria for individuals performing these controlled functions. What are the sort of three main pillars they assess?
Right. They look at three key interconnected areas. First up is integrity. This is all about the propriety of someone's conduct. It covers things like past criminal offenses, any legal or disciplinary actions, contraventions of law, that kind of thing.
Let's pause on integrity for a moment. The GPM specifically mentions the regulator assesses whether the individual has been candid and truthful in all their dealings. That sounds, it sounds like maybe being caught in a lie, even a small one, is worse than the original issue itself. Is that fair?
That's a very fair assessment. The regulator absolutely sees a failure to disclose, or just a general lack of candor, as immediate proof of compromised integrity. It speaks to conduct right now. You see, a past failing, maybe from years ago, that could potentially be explained, contextualized, maybe mitigated. But if you try to hide it during the application process, that act of concealment, that deceit, is seen as a major red flag, a contravention in itself. It's a direct test of present character.
Wow. Okay, so the stakes are incredibly high from the very beginning. What about the professional side, qualifications and such?
That falls squarely under the second pillar, competence and capability. Pretty straightforward. This ensures the individual has the right qualifications and, crucially, relevant experience for the specific controlled function role they're applying for. Then the third pillar is financial soundness. Here, they're checking the individual's ability to meet their debts when they fall due. This involves rigorous checks for any history of bankruptcy, receivership, or failure to satisfy court judgments relating to debt within the last 10 years.
A 10-year look back, that's serious due diligence. And speaking of serious scrutiny, I noticed this specific policy they have regarding startups.
Ah, yes. Because the whole approach is risk-based, startups naturally get higher degree of due diligence. It makes sense, right? They're new, less proven. They need to show a sound initial capital base, enough money to handle operating costs before revenue really starts flowing. And critically, their management team must clearly have the necessary expertise for the venture. The policy is even more specific in some areas. Applications for brand new startup banks or insurance companies are generally not accepted.
Generally not. So there's some wiggle room.
There is. They maintain discretion to consider truly exceptional cases on their individual merits, but the default stance is caution for those high-impact sectors.
Okay, so they really vet your history, your experience, your finances just to let you in. But once a firm is authorized, does the regulator finally ease off a bit? Or does that same level of scrutiny just continue into the supervision phase?
That intensity absolutely carries right through into the supervision mandate. The regulator says it wants an open, transparent, and cooperative relationship, which is good, but they actively manage risk using a structured risk management cycle. It involves identifying risks, assessing them, prioritizing, mitigating, and then continuously monitoring them. And they explicitly state that the firm's internal culture, its behavior that's considered a vital element affecting its long-term financial health. It's not just about the numbers on the balance sheet.
So how does that day-to-day monitoring actually work? What are the main tools in their toolkit for supervision?
They rely on three main methods, generally. First, you've got desktop reviews. That's where they analyze all the regular reports, regulatory returns, and management information the firm has to submit. Second, and very important, are on-site visits. These are crucial for the supervisors to get a real first-hand feel for the firm's people, its systems, its controls. It lets them gauge the actual compliance culture on the ground. And finally, they issue periodic communications. These might be letters sent to senior management discussing, say, thematic findings from across the industry or highlighting emerging risks they want firms to be aware of.
Within that governance structure, the GPM puts quite a bit of emphasis on independent directors. What does a director need to do or not do to be officially considered independent, according to this guidance?
Yeah, the criteria are designed to ensure genuine impartiality. The director must be independent in both character and judgment. Seems obvious, maybe. But specifically, it rules out people who've been employed by the firm or its group within the last 5 years, or anyone who's had a significant business relationship or received performance-related pay from the firm in the last 3 years. The aim is truly objective oversight, free from recent financial ties or management influence.
Right. Now, what if a firm, maybe because its business model is a bit unusual, finds a specific rule just doesn't fit or is maybe overly burdensome? I gather that's where waivers or modifications come in.
Correct. A firm can request a waiver, which grants relief from an entire rule, or a modification, which changes how a specific rule applies to them. However, it's not automatic. The firm has to present a really compelling case for why they need this relief, and they must clearly identify any new risks created by deviating from the standard rule and show how they'll mitigate those risks.
Okay, but why should we, as outsiders, clients, competitors, other market participants, even care if some firm gets a specific waiver? How does that affect us?
Because transparency is absolutely central here. The regulator generally publishes all its decisions on granting waivers and modifications. This means you, as a client or a competitor, know exactly to what extent the standard rules apply or don't apply to that specific firm. If a firm is operating under a modified rule set, that can fundamentally change its risk profile compared to its peers, and market users really have a right to know that.
It makes sense. So the rules are set, boundaries are clear, waivers might adjust them slightly. But what happens if that cooperative relationship breaks down? If a contravention, a breach is suspected, that's when the regulator's power really shifts up a gear into enforcement, right?
Right. And that power is, frankly, sweeping. Their information gathering power isn't just limited to the regulated firm itself. They can demand information and documents from authorized persons, from approved persons, from controllers, even from external parties like the firm's consultants or auditors. And simply failing to respond quickly or fully to these requests, that failure itself can be treated as a contravention.
But the power that really stands out, the one that seems most significant in the GPM's toolkit, is the power to compel testimony during an investigation.
It really is a critical differentiator. Investigators can legally require a person to attend an interview and answer their questions. And here's the crucial legal point the GPM explicitly highlights. The person being interviewed is not entitled to refuse to answer questions just because their answers might incriminate them.
Wow. That's a profound departure from what many people, especially those familiar with common law systems, might expect. It essentially removes the right to silence in that specific context.
Yeah.
Why is that power deemed so necessary?
It really underscores the paramount importance the ADGM FSRA places on the speed and effectiveness of its regulatory investigations. In essence, the regulator is prioritizing the integrity and stability of the financial market over the individual's right against self-incrimination in that moment. It tells you just how seriously they take uncovering misconduct. It dramatically simplifies, from their perspective, the process of getting to the facts when rules might have been broken. And furthermore, the GPM is very clear about what constitutes a breach. It's not just doing something prohibited, it's also failing to do something that's required. And their net is cast wide using the knowingly concerned clause. This means an individual can be held liable even if they didn't commit the primary breach themselves, but if they aided, abetted, or were just knowingly involved in someone else's contravention.
That knowingly concerned part seems important for catching people who might try to orchestrate things from behind the scenes without getting their own hands dirty, so to speak.
Exactly. It prevents individuals from hiding behind corporate structures or directing others to breach rules.
So when the regulator does find a contravention, and they've gathered the evidence, what's the range of disciplinary actions they can actually take?
It's extremely broad, really covers the spectrum. Beyond the obvious financial penalties, they can issue a public censure, essentially naming and shaming. They can suspend or even completely cancel the firm's financial services permission, its license to operate. For individuals, they can issue prohibition orders, which can permanently ban someone from performing any controlled function, or indeed any function at all, within the ADGM Financial Center. They can also pursue actions for damages through the courts, issue restitution orders to compensate victims, and in the most severe cases, they can even apply to have the company wound up liquidated.
That's a serious arsenal. But let's focus on the financial penalties. If they choose that route, how do they ensure the amount isn't just plucked out of thin air? Is there a methodology?
Oh yes, it's far from arbitrary. It follows a very strict 5-step calculation process, all underpinned by 3 core governing principles. Those principles are: 1, disgorgement. This is about removing any economic benefit or profit the firm or individual gained because of the contravention, taking away the ill-gotten gains. 2 is sanction. This is the part that actually penalizes the wrongdoing itself. And the third principle is deterrence, setting a penalty high enough to actively discourage the firm, and indeed others in the market, from committing similar breaches in the future.
Okay, 3 principles.
Yeah.
And the 5 steps to calculate the actual number. Can you walk us through those quickly?
Sure. Step 1 is calculating that disgorgement amount, how much profit was made or loss avoided due to the breach. Step 2 is determining the initial sanction level. This depends on how serious the contravention was. They look at the impact it had, its nature, whether it was deliberate misconduct or just reckless behavior. Step 3 involves adjusting that initial sanction figure. It can be increased for aggravating factors like trying to conceal the breach or failing to cooperate with the investigation. Or it can be decreased for mitigating factors, things like self-reporting the issue promptly, taking immediate steps to fix the problem, and compensating those affected.
Right, makes sense. Aggravating and mitigating factors. What's step 4?
Step 4 is a crucial check for deterrence. The regulator looks at the figure reached after Step 3 and asks, is this actually enough to deter this firm and others from doing this again? If not, they can increase the penalty specifically for deterrence purposes.
And step 5? That relates to settling the case.
Exactly. Step 5 applies a potential discount for cooperation and reaching an early settlement with the regulator. Saves time and resources. But, and this is a critical detail, that cooperation discount does not apply to the disgorgement amount calculated back in Step 1. The principle is clear. You don't get a discount on returning profits you shouldn't have made in the first place. And one final point on penalties. The regulator will consider claims of serious financial hardship from firms or individuals who say they can't afford the penalty, but the burden of proof is entirely on them to provide verifiable, full, and honest evidence to back up that claim.
So putting it all together, what's the big picture here? The ADGM, FSRA, GPM, it really paints a portrait of a regulator absolutely committed to integrity, doesn't it? Employing this deeply rigorous, risk-based approach at literally every stage. We see incredibly detailed scrutiny of who they even let into the market in the first place, continuous oversight, and then this clear willingness to use quite exceptional powers, like compelling testimony without the right to silence, to make sure the rules are actually followed.
It does. And that whole framework of power, while expensive, is underpinned by a stated commitment to due process. The regulator exercises these powers through various appointed delegates, the chief executive, designated investigators, specific committees, but the GPM itself requires this delegation process to stick to principles of natural justice and procedural fairness when decisions are made. So there are checks and balances.
And finally, that point about transparency comes back again. The regulator generally publishes all its decisions about waivers and, crucially, about enforcement actions. They explicitly state that if not publishing might unfairly prejudice market users or the public, then publication will happen. Which brings us to a final thought for you, the listener, to mull over. In today's financial markets, where trust and integrity are absolutely paramount, does the perceived threat of public exposure, the risk of having your firm's name or your own name attached to a public censure, damaging that hard-won reputation, does that perhaps hold more preventative power over misconduct than the actual dollar amount of the financial penalty itself? Something to think about.